We've got a stock in the portfolio, it hasn't been in there that long, it's called Electro-Optic Systems. They use laser targeting. What does laser target? It can target satellites moving around in the sky, and that's about half their business. And the other half is used by the military to target enemy on the battlefield, on the land, but also for drones to some extent as well. So it's obviously a very interesting business, and you think, well, it sounds a bit pie in the sky. Is it really worth anything? Well, the company's been delivering profit, and in fact, it can forecast that its sales for financial year 2020 are going to be about $250 million. And that's on the back of existing contracts that they've won, and there are more contracts coming up all the time. They've got a product that is the absolute number one in its space, and so they've been winning all the contracts that have been coming up for them lately. Now, on the back of that, they're able to forecast they're going to have an NPAT of $25 million in that year, yet the market cap of the company is only about $250 million. So what we've got here is a company that's got revenue growth of about 40% per annum going into 2020, and it's trading on a P of 10. So that really is very much a company that's growing strongly. The insight that we have is around the market not appreciating that, really because it's just an overlooked stock. It's only got one small broker that's covering it. No doubt more brokers will come on. It's not in the index at the moment. It's not even in the ASX 300. Yet it's got a market cap of 250 million. So we think this stock is going to raise its profile a little bit over the next year or two as it delivers, and more fund managers and more investors are going to become aware of it. It'll get re-rated at the same time as it's going to have an acceleration of its earnings. In that stock in particular, it's very hard to see it. It's got about $50 million worth of cash. It's got absolutely no debt on a market cap of $250 million. It's got government contracts that are actually signed and locked in. It's got a history of under-promising and over-delivering. And the contracts that are still yet to be bid on are multiples of the existing contracts. So it's just a tough one. I suppose you could argue that some investors are going to be turned off by the fact that it's assisting the military in their endeavours, and so that might mean it has a less of a rating over time than it would otherwise have, but surely 10 times for a company that's doing 40% revenue growth and a multiple of that for earnings growth is just too low.